A company announces layoffs. Thousands of employees lose their jobs. Offices close. Products become less reliable. Customer service deteriorates. Growth slows. The business looks weaker than it did a year earlier. Then the stock price rises. To anyone watching from outside Wall Street, this can look irrational. If the company's getting worse, the stock should be getting cheaper. If customers are unhappy, workers are being cut, and management is retreating from expensive projects, investors should be worried. But the stock market is not designed to grade companies on how healthy, admired, or useful they appear today. It is designed to estimate how much cash their owners may receive in the future. Those are not the same thing. A company can become worse for employees, worse for customers, and even worse for the long-term strength of its product while becoming more attractive to shareholders. In some cases, is exactly makes the stock rise. This contradiction became impossible to ignore during the technology industry's reversal after the pandemic boom. Companies that had spent years promising expansion suddenly discovered a new vocabulary: efficiency, discipline, focus, restructuring, prioritization. Behind those words were layoffs, cancelled projects, smaller real estate footprints, reduced hiring, and tighter budgets. Meta became one of the clearest examples. During the pandemic, the company expanded aggressively. Demand for digital advertising recovered. Online activity surged. Technology companies hired as though years of future growth had arrived all at once. Meta increased spending on employees, infrastructure, and its long-term vision for virtual reality. Then the environment changed. Advertising growth slowed. Interest rates rose. Investors became led to reward distant promises. Meta's Reality Labs division continued consuming billions of dollars while producing relatively little revenue. The company's stock fell sharply, and the market began treating Meta not as an unstoppable technology platform, but as a bloated organization spending too much money on uncertain ambitions. The obvious explanation for the collapse was that Meta's business had weakened. That was partly true. But it was not the complete explanation. The market was not only reacting to slowing revenue, it was reacting to the belief that management had lost control of costs. Investors did not know how much money Meta would continue pouring into employees, data centers, office space, and the metaverse. The company still owned Facebook, Instagram, WhatsApp, and one of the largest digital advertising systems in the world. The underlying cash machine had not disappeared. What disappeared was confidence that shareholders would benefit from it. That distinction matters. A business can generate enormous amounts of revenue while destroying shareholder value if management spends the cash faster than investors believe it can earn a return. On the other hand, a business with slower growth can become more valuable if it convinces the market that a larger share of each future dollar of revenue will become profit. Meta's response was not to invent a new social network overnight. It was to change the financial story. In late 2022, the company announced a major workforce reduction. A few months later, it announced plans to cut roughly 10,000 additional positions and close thousands of unfilled roles. Management reduced its expense expectations, consolidated offices, cancelled projects, and described 2023 as a year of efficiency. The product did not suddenly become twice as good. Facebook did not become fashionable again because a finance department revised a spreadsheet. Instagram users did not celebrate because management reduced office space. The metaverse did not immediately justify the money already spent on it. What changed was the relationship between revenue and cost. For investors, every dollar a company does not spend can become a dollar future operating profit. Every employee removed from payroll reduces salary, benefits, stock compensation, management overhead, office requirements, and supporting expenses. Every cancelled project eliminates not only its direct cost, but years of uncertain future spending. A layoff announcement, painful evidence that a company misjudged its growth. But it can also be evidence that management is finally responding to the mistake. That is why the same announcement can look like failure to an employee and discipline to a shareholder. The employee sees lost income. The customer sees fewer people maintaining the product. The executive sees a lower expense base. The investor sees higher potential margins. The stock price reflects the last perspective more than the first three. This does not mean investors enjoy layoffs for their own sake. It means the market assigns value according to expected future cash flows. If cutting 10,000 jobs reduces future expenses by more than it damages revenue, the company may become financially stronger even as the organization becomes smaller. The mechanism is operating leverage. Many large companies have a substantial base of fixed or semi-fixed costs. They pay engineers, sales teams, administrators, offices, data centers, software contracts, and management salaries before knowing exactly how much revenue they will produce. When revenue grows quickly, those costs can become easier to absorb. Profit rises faster because the company does not need to increase every expense at the same rate as sales. But the mechanism also works in reverse. When revenue growth slows, a cost structure built for expansion becomes a burden. Payroll continues. Offices remain open, stock compensation accumulates, projects keep consuming cash. The company may still be profitable, but each additional expense makes the future less attractive. Investors then begin asking a different question. Not how fast can this company grow, but how much of the money it already earns can management stop wasting. This is the first reason a stock can rise, while a business appears to get worse. The market may believe that the company is becoming more efficient, even if the customer experience or employee culture deteriorates. But cost-cutting is only one layer. A stock is not a direct measurement of current business performance. It is a price formed by buyers and sellers competing over expectations. That price can change dramatically even when the current business changes very little. Consider what investors are actually purchasing. They are not buying the company's revenue from last year. That revenue already happened. They are buying a claim on the company's future earnings, future cash flows, future dividends, future buybacks, and future resale value. The past matters only because it helps investors estimate what comes next. This is why a company can report declining profit and still see its stock rise. If investors expected an even worse decline, the result is positive relative to expectations. A terrible quarter can be good news when the market had already priced in a disaster. The stock market does not ask whether the result was good. It asks whether the result was better or worse than the price already assumed. That difference creates some of the strangest reactions in financial markets. A company can announce record revenue and watch its stock fall because investors expected faster growth. Another company can announce shrinking sales and watch its stock rise because the decline was smaller than feared. The direction of the business and the direction of the stock do not have to match in the short term because the stock is moving against expectations, not against the previous year. Imagine two restaurants. The first restaurant earns $1 million in profit, but investors expected $2 million. The second restaurant loses $1 million, but investors expected it to lose $3 million. The first business is more profitable. The second result is more surprising. In the stock market, surprise often matters more than the absolute number. This is why earnings announcements can appear disconnected from reality. The headline says revenue fell, the stock rises. The headline says profit increased, the stock falls. The missing information is the expectation embedded in the price before the announcement. A stock that has already collapsed may contain very little optimism. Investors may already assume declining sales, shrinking margins, customer losses, and management failure. When the company reports results that are merely bad instead of catastrophic, buyers return. The business has not become healthy. The probability of complete failure has simply declined. This is where the popular explanation begins to fall apart. People often assume that rising stock prices prove a company is succeeding. They do not. A rising stock price proves that buyers are willing to pay more than before for a claim on the company's future. That belief may be based on stronger demand, a better product, or faster growth. But it can also be based on layoffs, tax changes, lower interest rates, asset sales, reduced competition, debt refinancings, share repurchases, or the simple realization that the previous price was too pessimistic. The stock can celebrate a future that customers may not enjoy. Take a company that dominates a market but has allowed its product quality to decline. Customers complain, yet they remain because switching is inconvenient. Competitors are weak. The company cuts support staff, slows investment, and raises prices. From a customer perspective, the business is getting worse. From an investor perspective, the company may be demonstrating pricing power. Pricing power means a business can charge more without losing enough customers to damage revenue. It is one of the most valuable characteristics a company can possess. A product does not need to be loved if customers feel trapped, dependent, or unwilling to switch. Under this model, dissatisfaction is not automatically a financial problem. It becomes a financial problem only when dissatisfied customers leave, spend less, or force the company to increase costs to keep them. Until then, a worse customer experience can coexist with higher margins. Airlines provide a familiar version of this contradiction. A carrier can reduce legroom, charge for more services, make loyalty rewards harder to use, and still improve its economics if passengers have limited alternatives. The product feels worse, but each customer becomes more profitable. software companies can do the same through subscriptions. A platform can raise prices, restrict features, reduce support, and make cancellation difficult. Customers become angrier, but recurring revenue becomes more predictable. Consumer brands can shrink package sizes while keeping shelf prices stable. The customer receives less product, but the company protects its margin. In each case, the business may be weakening as an experience while strengthening as a financial instrument. That is the central contradiction. The stock market does not reward a company for being generous. It rewards a company for turning resources, customers, and market power into future cash. Sometimes the best way to do that is to build a better product. Sometimes it is to cut costs. Sometimes it is to raise prices. Sometimes it is to reduce competition. And sometimes it is to make the product just good enough that customers complain but do not leave. This does not mean stock prices are always rational. Markets can become speculative. Investors can chase momentum, follow narratives, and buy companies they do not understand. Options trading, short covering, index flows, and social media excitement can push a stock far beyond any reasonable estimate of business value. But even those movements begin with the same structure. A stock is a market for expectations. The business is only the underlying asset. To understand why a stock can skyrocket while the company looks worse, the first step is to stop treating the share price as a report card. It is closer to a constantly changing auction over what the company might produce, what it might cut, what it might return to shareholders, and how wrong the previous buyers may have been. The next layer is where this becomes more uncomfortable, because once a company learns that Wall Street will reward lower costs, higher margins, buybacks, and tighter control, management begins changing the business around those incentives. The stock price does not merely react to the company. Eventually, the company begins reacting to the stock price. The stock market's favorite number is not revenue. It is not employee count. It is not customer satisfaction. It is not even profit by itself. What matters is how much profit belongs to each share, how reliably that profit can grow, and how much investors are willing to pay for it. This is where the financial version of a company begins to separate from the operating reality. A business may sell fewer products, employ fewer people, and invest less in its future while still increasing earnings per share. To understand how, imagine a company earning $1 billion with 1 billion shares outstanding. Each share represents $1 of earnings. Now imagine the company's total profit remains exactly the same, but it buys back 100 million shares. The business has not grown. It has not found new customers. It has not improved its product. But the same $1 billion of profit is now divided across fewer shares. Earnings per share rises. This is the basic mechanism behind share repurchases. A buyback allows a company to use cash to purchase its own stock, removing shares from the market or holding them in treasury. With fewer shares outstanding, each remaining share owns a slightly larger claim on the business. For shareholders, that can be valuable. For executives whose compensation depends on earnings per share or the stock price, it can be extremely valuable. And for a company struggling to produce organic growth, buybacks offer a different way to improve the financial appearance of growth. The company does not need to sell more. It can reduce the denominator. This does not make buybacks inherently deceptive. A profitable company with limited investment opportunities may return excess cash to shareholders through repurchases. When shares are undervalued, buying them back can be a rational use of capital. The problem begins when repurchases replace investment rather than follow it. A company can cut research, reduce maintenance, shrink customer support, delay product development, and use the resulting cash to buy back stock. In the short term, margins improve and the share count falls. Earnings per share rises. The stock may follow. The customer experiences deterioration. The shareholder experiences financial concentration. Both outcomes can come from the same decision. This is why a company's stock can perform well, while the organization beneath it becomes more fragile. The market may be rewarding the efficient extraction of value from an existing business, not the creation of a stronger future business. Once a company reaches maturity, that distinction becomes more important. Young companies are often valued for expansion. Investors tolerate low profits because the business is acquiring customers, entering markets, and building infrastructure. Spending is treated as investment because the company is believed to have a long runway. But that patience is conditional. When growth slows, the same spending can suddenly look wasteful. Employees who once represented future capacity become overhead. Research projects become distractions. New offices become evidence of excess. Management is pushed to prove that the company can convert its scale into cash. The business enters a different phase. It stops being rewarded for possibility and starts being judged on extraction. This transition can create a sharp increase in the stock price even though the company's ambitions are shrinking. Investors may prefer a smaller, more profitable business to a larger, less disciplined one. They may reward management for abandoning markets, selling assets, closing divisions, or retreating from expensive experiments. From the outside, this can look like decline. From the market's perspective, it can look like focus. The word focus has become one of the most useful terms in corporate communication because it turns retreat into strategy. A company is not cancelling projects because they failed. It is focusing on core priorities. It is not laying off employees because management hired too aggressively. It is aligning resources with opportunity. It is not reducing investment because growth disappeared. It is improving capital allocation. The language is polished, but the mechanism is simple. Spend less, keep more, return more to shareholders. The stock can rise because investors believe the company has moved from uncontrolled expansion to controlled cash generation. This is also why activist investors often target companies that appear bloated, diversified, or poorly managed. They may demand cost reductions, asset sales, management changes, buybacks, or the separation of business units. The activist does not necessarily believe the company's products can become more innovative. The thesis may be that the company already owns valuable assets, but management is failing to extract enough profit from them. A division may be worth more when sold than when operated. A brand may be worth more when licensed than when developed. A real estate portfolio may be worth more when separated from the retail business that occupies it. A company may be worth more in pieces than as a complete organization. When the market begins to believe that breakup, liquidation, or restructuring will unlock value, the stock can rise even while the operating company becomes smaller. This reveals a deeper difference between business value and stock value. A business is an organization built to produce goods or services. A stock is a financial claim that can be improved through changes in ownership, capital structure, taxes, debt, share count, and cash distribution. The product is only one part of the equation. Sometimes the market is not betting that the company will become better at serving customers. It is betting that management will become better at serving capital. Debt can intensify this process. Suppose a company borrows money and uses the proceeds to repurchase shares. If the cost of that debt is lower than the earnings yield investors expect from the stock, the transaction may increase earnings per share and support the share price. Again, the operating business may not improve at all. The company has simply replaced equity with debt. Make returns look stronger because fewer shareholders divide the profit. But it also makes the company more fragile. Interest payments become mandatory. Debt must eventually be refinanced or repaid. A downturn that was once manageable can become dangerous because the company has less flexibility. The stock may rise when the leverage is added. The consequences may arrive years later. This creates one of Wall Street's most persistent contradictions. A decision can increase shareholder returns while weakening the company's ability to survive stress. Financial engineering pulls value forward. It converts future flexibility into present performance. For executives, this can be rational. Their compensation may depend on the stock price over a limited period. Investors may demand results this quarter or this year. Directors may fear activist pressure. Analysts may punish spending that reduces near-term margins. The company is not managed for eternity. It is being managed inside a financial calendar. This is where incentives begin reshaping the product. Imagine a software company with a reliable customer base. It can improve support, rebuild aging infrastructure, and develop new features. Those investments may strengthen the business over 5 years, but they reduce profit today. Or it can raise subscription prices, cut service staff, slow development, and repurchase shares. Those decisions may increase margins immediately. If executives are rewarded for near-term earnings and stock performance, the second path can become more attractive even when it creates long-term risk. The company does not need to destroy the product, it only needs to extract more from it than it puts back. This is the logic of harvesting. A harvested business is not managed primarily for growth. It is managed to produce cash from an established customer base, brand, or market position. Investment is reduced to the minimum necessary to prevent rapid decline. Prices may rise. Service may weaken. Innovation becomes selective. The business can remain profitable for years. The stock may perform well during the harvest because free cash flow increases, but the customer is slowly consuming yesterday's investment. The reliable software was built years earlier. The trusted brand was created by previous products. The distribution network was established under a different management philosophy. The loyalty was earned before extraction became the priority. Financial markets can reward the company for monetizing these assets, even as the assets are being depleted. The challenge is that depletion is difficult to measure. A financial statement can show lower expenses immediately. It cannot easily show how much trust was lost, how many future products were never created, or how much technical debt accumulated. Customer frustration may not appear in revenue until switching becomes possible. Employee departures may not appear in profit until institutional knowledge is needed. Brand decline may remain hidden until a competitor offers a credible alternative. By the time the damage reaches the income statement, the executives who made the decisions may already have been rewarded. This does not mean every cost reduction is destructive. Companies become inefficient. Teams duplicate work. Projects survive without economic justification. Management layers accumulate. Expansion creates bureaucracy. Cutting those costs can genuinely improve a business. The difficult question is not whether expenses fell. It is what those expenses were doing. Removing a redundant approval process is different from removing quality control. Closing an unused office is different from eliminating product testing. Cancelling a failed experiment is different from abandoning all long-term research. A financial model often treats these costs as equal because each appears as an expense. The operating consequences are not equal. Wall Street may initially reward both. Only time inside the business reveals the difference. The same distortion appears in mergers and acquisitions. When a company announces an acquisition, management often promises synergies. Synergy is the financial language for producing more profit from the combined companies than they could produce separately. Some synergies come from genuine scale. The companies may share distribution, combine technology, or negotiate better supplier terms. But many synergies come from removing people. Two companies do not need two headquarters, two finance departments, two human resources teams, or two groups of senior executives. Jobs are limited. Offices close. Products are consolidated. Investment priorities narrow. The combined company may become less innovative and less responsive while becoming more profitable. The stock can rise because investors believe the acquisition will reduce competition and lower duplicated costs. Customers may see fewer choices. Employees may see fewer opportunities. Shareholders may see higher margins. Once again, the contradiction is not accidental. The financial benefit may come directly from the operating deterioration. This is especially powerful in concentrated industries. When a company faces intense competition, poor service creates consequences. Customers leave, competitors take market share, prices fall, management is forced to improve. But when only a few companies control the market, the punishment weakens. Every competitor may raise prices together, every platform may reduce service, every airline may add fees, every media company may increase subscriptions. Customers can switch, but the alternatives may operate under similar incentives. Market concentration turns customer dissatisfaction into a manageable cost. This makes a declining product more valuable than it should be. The company does not need customers to be happy. It needs them to remain. That difference is the foundation of pricing power. When investors believe a company can raise prices faster than costs without losing meaningful demand, the stock may rise even if the product does not improve. Higher prices increase revenue. If costs remain controlled, profit expands even faster. For the customer, the value proposition gets worse. For the company, the unit economics improve. This is why inflationary periods can reveal which companies possess real market power. Some businesses absorb higher costs because they fear losing customers. Others pass those costs through immediately. The strongest companies may raise prices beyond the increase in their own expenses and keep the difference. Consumers call it getting less for more. Investors call it margin expansion. The language changes depending on who receives the benefit, but even strong margins do not fully explain why a stock can skyrocket. Sometimes the movement has very little with long-term business value. A heavily shorted stock can rise because traders who bet against it are forced to buy. Short selling begins when an investor borrows shares and sells them, hoping to repurchase them later at a lower price. If the stock falls, the investor keeps the difference. If the stock rises, the loss grows. Unlike buying a stock where the maximum loss is the original investment, a short position has no fixed ceiling. A stock can rise far beyond the price at which it was sold. When enough short sellers rush to exit at the same time, they must buy shares to close their positions. That buying pushes the price higher, creating losses for other short sellers and forcing more of them to buy. The stock rises because it is rising. This is a short squeeze. The underlying company may still be weak. Revenue may still be declining. Debt may still be dangerous. Customers may still be leaving. None of that prevents the price from exploding when the supply of available shares is limited and short sellers are trapped. Options can intensify the move. When traders buy large numbers of call options, the market makers who sold those contracts may purchase shares to manage their own risk. That additional buying can push the price higher, forcing more hedging and creating another feedback loop. The stock becomes disconnected from the pace of the business, because the price is being driven by positioning. This is not investing in the traditional sense, it is market structure. The share price becomes a battleground between traders, algorithms, options dizzy, index funds, and short sellers. The company's actual operations become almost secondary. For management, however, even a speculative surge can create real opportunity. A company with an inflated stock price can sell new shares to the market and raise cash. It can use expensive stock to acquire other companies. It can refinance debt, strengthen its balance sheet, or extend its survival. A stock rally that began without business improvement can eventually improve the business by giving the company access to capital. The market narrative creates financial reality. This feedback loop is one reason stock prices matter so much to executives. A higher share price lowers the apparent cost of raising equity. It improves the value of employee compensation. It strengthens acquisition currency. It increases confidence among suppliers and lenders. The stock price is not only a reaction to the business, it can become a resource the business uses. This is why executives spend so much time managing expectations. They guide analysts toward revenue ranges. They emphasize certain metrics, describe expenses as investments when growth is rewarded, and describe the same expenses as inefficiencies when margins are rewarded. The strategy may not change as quickly as the language. The financial story does. During optimistic markets, executives sell possibility. During fearful markets, they sell discipline. When investors reward expansion, management announces new markets, products, employees, and infrastructure. When investors reward efficiency, management announces layoffs, focus, buybacks, and cash returns. The company learns what the market wants and restructures its identity around that demand. This can create an uncomfortable reversal. Investors are supposed to analyze the company, but the company is also analyzing investors. Management studies which announcements raise the stock, which metrics analysts emphasize, and which expenses shareholders will tolerate. Over time, corporate behavior adapts to the measurement system. What gets rewarded gets repeated. If cost-cutting produces a stock rally, more costs are cut. If buybacks support earnings per share, more shares are repurchased. If price increases do not cause customers to leave, prices rise again. If layoffs are interpreted as discipline rather than distress, headcount becomes a financial lever. The stock market does not simply discover value. It teaches companies what kind of value to create. And when the market values extraction more highly than investment, a company can become more financially efficient while becoming less capable, less innovative, and less useful. The stock rises because the business is producing more for shareholders. The business gets worse because it is producing less for everyone else. The uncomfortable part is that none of this requires the stock market to be irrational. A company can become more valuable precisely because it has learned how little it must give customers, employees, or suppliers before they finally leave. That is not always permanent, it is not always sustainable, but it can be financially rational for much longer than most people expect. The reason is timing. The benefits of extraction appear quickly. The damage appears slowly. Layoffs reduce payroll almost immediately. A price increase reaches revenue in the next billing cycle. A cancelled project lowers expenses this year. A buyback reduces the share count as soon as the transaction is completed. But weaker customer service may take years to reduce retention. Less research may not matter until the next product cycle. Lower maintenance may remain invisible until a critical failure. A damaged culture does not appear as a line item. Lost trust does not arrive with a clear invoice. The financial statement captures the savings before it captures the decay. This timing difference is one reason markets can reward decisions that eventually weaken the business. Investors are not necessarily ignoring the risk. They may simply believe the company can extract value for several more years before the consequences become large enough to matter. For a shareholder with a shorter time horizon, that may be enough. For an executive compensated over a few years, it may be more than enough. The company becomes trapped between two clocks. The operating clock measures product cycles, employee capability, customer trust, and long-term investment. The financial clock measures quarterly earnings, annual targets, analyst expectations, and the stock price. When those clocks conflict, the financial clock usually speaks louder. A chief executive can explain that a research program may create a valuable product 7 years from now. But the cost is visible today, the outcome is uncertain, and the executive may not remain in the job long enough to receive credit. A cost reduction produces a cleaner result. It can be measured, it can be announced, it can be placed into guidance, it can be rewarded before its consequences become obvious. This creates a bias toward decisions that are financially legible. Markets prefer actions they can model. A reduction in headcount can be entered into a spreadsheet. A future breakthrough cannot. A higher subscription price can be estimated. The value of preserving customer goodwill is harder to calculate. The most measurable decision is not always the best decision. It is simply the easiest decision to reward. This helps explain why companies can appear to become more disciplined at exactly the moment they become less ambitious. The business stops asking what it could build. It starts asking what it can remove without causing immediate damage. At first, the results may look impressive. Margins expand, free cash flow improves, earnings per share rises. The stock re-rates because investors are willing to pay a higher multiple for a company that appears more predictable. That multiple matters. Two companies can earn the same amount of profit and have very different stock prices because investors do not only value current earnings. They assign a multiple based on expected growth, risk, durability, and interest rates. A company believed to have stable, recurring, defensible earnings may receive a higher valuation than one with unpredictable profits, even if both currently earn the same amount. This is why a stock can skyrocket without a dramatic change in today's profit. Investors may simply decide that the future deserves a different price. If a company was previously valued at 10 times expected earnings and the market later values it at 20 times earnings, the share price can rise substantially even if the underlying earnings estimate changes very little. The business did not double overnight. The market changed the price it was willing to pay for the same stream of cash. This re-rating can happen when interest rates fall, when bankruptcy risk declines, when a new management team gains credibility, or when investors believe a temporary problem has been solved. It can also happen when a company successfully changes its identity. A hardware company may convince investors that it is becoming a subscription company. A retailer may present itself as an advertising platform. An automaker may be valued as a technology company. A media company may emphasize recurring revenue rather than declining traditional sales. The new story can receive a higher multiple than the old one. That does not make the story false, but it means the stock can move faster than the operating transformation. Narrative is not separate from the narrative shapes which financial category investors place the company inside. A low-margin business may be priced cautiously. A platform is priced for scale. A cyclical company is priced for volatility. A recurring revenue company is priced for predictability. Management, therefore, has a strong incentive to describe the business using the language of whichever category receives the highest valuation. Sometimes the business eventually earns the identity. Sometimes the stock gets there first. This is where the phrase "the market is forward-looking" becomes both useful and dangerous. It is useful because stock prices do attempt to reflect future conditions. It is dangerous because the future is not known. Investors build models from assumptions. They estimate growth, margins, competition, interest rates, customer behavior, and management quality. Small changes in those assumptions can create large changes in valuation. A stock price is not a fact about the future. It is a price attached to a collective forecast. That forecast can be wrong. The market may reward a company for cutting too deeply. It may assume customers are more loyal than they are. It may believe a price increase is sustainable when it is actually pushing users toward competitors. It may mistake temporary margin expansion for permanent efficiency. The company can appear stronger right before the damage becomes visible. This has happened repeatedly in businesses that underinvest in maintenance. Airlines can defer spending until operational reliability declines. Retailers can reduce store labor until shelves remain empty and checkout lines grow. Manufacturers can push suppliers until quality problems appear. Software companies can delay infrastructure work until outages become common. Media companies can cut content spending until subscribers stop finding reasons to stay. For a period, every one of these decisions can improve reported economics. Then the system reaches a threshold. The customer leaves. The employee with critical knowledge resigns. The supplier stops accepting the terms. The product fails. The regulator intervenes. The competitor becomes credible. At that point, the cost of rebuilding may exceed the savings that created the problem. This is the limit of financial extraction. A company can monetize trust, but it cannot repeatedly recreate trust at the same speed. It can cut capacity, but rebuilding capacity takes time. It can raise prices, but only until the customer discovers an alternative. It can reduce competition through scale, but concentrated markets often attract regulatory attention. It can use buybacks to increase earnings per share, But buybacks cannot permanently replace earnings growth. Eventually, the operating business must support the financial story. This is the strongest counter-argument to the idea that Wall Street rewards deterioration. Markets do not reward weak companies forever. A falling quality product, a shrinking customer base, or a damaged brand will eventually reduce cash flow if the damage is severe enough. Investors may tolerate short-term pain, but they do not willingly pay for permanent decline unless they believe there is value in the assets, the balance sheet, or a possible turnaround. The stock market is not indifferent to the business. It is selective about which parts of the business matter financially. Employee morale matters when it affects execution. Customer satisfaction matters when it affects retention or pricing power. Product quality matters when it affects demand. Innovation matters when it affects future cash flow. The market's moral language is extremely limited. It does not reward a company because it treats people well. It rewards the financial consequences of treating people well. That difference can make the system feel cruel, but it also makes the mechanism clearer. A company that pays employees more may create stronger retention, better service, higher productivity, and lower hiring costs. If those benefits improve cash flow, the market can reward the decision. A company that invests heavily in product quality may create loyalty pricing power. If the investment produces durable earnings, the market can reward that too. The market is not structurally opposed to good products or strong workplaces. It simply demands translation. Every investment must eventually become revenue, margin, cash flow, resilience, or lower risk. The problem is that some benefits take years to prove, while cost-cutting can be proven next quarter. That asymmetry shapes behavior. It encourages management to favor what can be measured now over what may matter later. It encourages investors to celebrate visible savings and underestimate invisible deterioration. And it encourages companies to confuse a rising stock price with validation of every operating decision beneath it. That is where the stock price becomes dangerous. A rally can convince management that the strategy is working even when the market is rewarding only one narrow feature of it. Investors may approve of lower expenses, not weaker innovation. They may approve of exiting a failed project, not abandoning all long-term investment. They may approve of disciplined pricing, not permanent customer exploitation. But management sees the share price rise and learns a simpler lesson: do more of what just worked. This feedback loop can continue until the company overcorrects. Efficiency becomes austerity, focus becomes stagnation. Pricing power becomes customer resentment. Buybacks become financial dependence. Cost control becomes institutional damage. The same mechanism that rescued the stock can eventually undermine the business. That is why the question, why did the stock price skyrocket, cannot be answered by looking at the product alone. The answer may sit inside expectations. The result was better than feared. The answer may sit inside margins. The company learned to earn more from less. The answer may sit inside capital structure. Fewer shares now divide the same profit. The answer may sit inside market power. Customers are unhappy, but they are not leaving. The answer may sit inside positioning. Short sellers were forced to buy. Or the answer may sit inside narrative. Investors decided the same company deserved a different valuation. None of these explanations require the business to become visibly better. They require the financial claim on the business to become more attractive. That is the distinction most observers miss. A company is judged by many groups at once. Customers judge the product. Employees judge the workplace. Suppliers judge the relationship. Regulators judge the conduct. Investors judge the future cash flows. Those judgments can move in opposite directions. A worst product can produce higher margins. A smaller workforce can produce higher earnings. A weaker long-term organization can produce stronger short-term cash flow. A declining company can still become a successful trade. The stock price is not lying when it rises. It is answering a different question. Not whether the company became better, not whether the product improved, not whether employees are safer, not whether customers are happier. It is answering whether the expected financial reward attached to each remaining share has increased. Sometimes that increase comes from innovation. Sometimes it comes from efficiencies. Sometimes it comes from scarcity, leverage, speculation, or a lower level of fear. And sometimes it comes from discovering that the business can give people less without losing their money. The real lesson is not that stock prices are disconnected from companies. It is that they are connected to a narrower version of the company than most people realize. The customer sees what the business provides. The market sees what the business can extract. When those two measures separate, the stock can skyrocket at the exact moment the company starts becoming worse.